Should you invest in SpaceX? It's the question everyone is asking right now, and almost everyone is asking it the wrong way. They're asking, is SpaceX a great company? And the answer to that is obvious. Of course it is, but that's not the question that decides whether you make money. The question that actually matters is quieter and a lot less exciting. Is SpaceX a great investment at the price you'd be paying today? Those two questions feel identical. They are not. And the entire distance between them is where ordinary investors quietly lose money on deals, exactly like this one. Let me show you what I mean with two quick stories. A few years ago, Rivian went public to enormous excitement. Its first day was electric. The stock popped more than 20%, and thousands of people piled in convinced they were early. Over the next year, it fell roughly 67%. Around the same time, Reddit went public and did the opposite. It looked soft out of the gate, almost disappointing, and then it climbed nearly 150%. Same market, opposite outcomes, and in both cases, the first day told you absolutely nothing. So before you let a green number on a screen make this decision for you, let's actually do the math the hype is counting on you to skip. Let me be clear about what this video is and what it isn't, because I want to be fair. This is not a video about SpaceX being a bad company. By almost any measure, it's one of the most remarkable companies on Earth. It launches more rockets than most countries. Its satellite network reaches more than 150 countries and serves millions of people who could never get online before. If you came here hoping I'd tell you the rockets won't fly, you're in the wrong place. The rockets fly. This is about something subtler and honestly more important. It's about the difference between admiring a company and handing it your money at a specific price on a specific day. Those are not the same act, and confusing them is the single most expensive mistake retail investors make. So let's build this properly, from the ground up, because every conclusion at the end depends on getting the foundation right. For most of its life, SpaceX has been private. That means its shares were locked away with a small circle, the founder, the employees, and the investment firms that funded it along the way. You couldn't buy in no matter how badly you wanted to. Going public is the moment that door opens. The company sells a slice of itself to the public, and from then on, the shares trade on an exchange where anyone can buy and sell. That's the part everyone's excited about. The door is finally open, but an open door is not the same as a good deal waiting on the other side. Here's the first thing the headlines skip. There isn't one price in a deal like this. There are two. The first is the official offering price, set quietly before the stock ever trades, negotiated between the company and the big banks running the show. Those shares go almost entirely to large institutions and a thin layer of insiders. The second price is the one you'll actually pay, the price the stock opens at when public trading begins. And for a deal this hyped, that opening price is almost always higher, often dramatically higher than the insiders paid. Hold on to that gap between the two prices. We're going to come back to exactly who pockets it. Now let's be honest about what's actually underneath the stock, using the company's own numbers. Last year, SpaceX brought in around $18.7 billion in revenue. That's a genuinely large business, no argument. But here's what the breathless coverage buries. In that same year, the company didn't make a profit. It lost somewhere around $4.9 billion. And when you look at where the revenue even comes from, the story most people carry in their heads falls apart. We all picture SpaceX as a rocket company. But the rockets aren't the engine anymore. The biggest piece by far is Starlink, the satellite internet service, which brought in roughly $11.4 billion, about 61% of everything. More than that, Starlink is essentially the only part of the whole operation turning a real profit, generating around $4.4 billion in operating income. The launch business is growing, but slowly, and the newer, flashier bets are still burning cash, not making it. So when you buy a share of SpaceX, picture what you're really buying. One profitable engine, Starlink, dragging several heavier, money-losing cars behind it. Maybe those cars become valuable someday. There's a real case that they do. But someday is carrying an enormous amount of weight in that sentence. And as you're about to see, the price you'd pay today is written as if someday has already arrived. Now let's talk about that price, because this is where it gets uncomfortable. The number you'll hear everywhere is a valuation of about $1.75 trillion. And most coverage just lets the size of that number do the work. But the size isn't the revealing part. The speed is. Rewind less than a year, In the middle of last year, SpaceX was valued privately at around $400 billion. By the time it goes public, that figure is $1.75 trillion. That's more than 4 times higher in roughly 11 months. So you'd assume the business itself quadrupled, right? It didn't. Revenue grew by maybe a third. The rockets didn't get 4 times better. The satellites didn't quadruple overnight. What got 4 times bigger wasn't the company. It was the story being told about the company. Let me put that price in terms you can actually judge. At $1.75 trillion against about $18.7 billion in sales, you're paying roughly $94 for every single dollar of revenue this business produces. 94 to 1. For a company that is, right now, losing money. To give you a sense of how extreme that is, most large, established, genuinely profitable companies trade somewhere in the low single digits to low double digits on that same measure. Even the market's most beloved darlings rarely hold anywhere near 94. And this isn't just my read. One of the most respected independent research firms on Wall Street ran its own detailed valuation and concluded SpaceX is worth closer to $780 billion, more than half below the price it's debuting at. Notice something about that number. $780 billion is almost exactly what the company was privately valued at just months before. In other words, the entire sprint up to $1.75 trillion happened in the short window right before the public was finally invited in. Here's one more way to feel how stretched this is. Starlink, the only piece actually making money, throws off about $4.4 billion in operating profit. Value that generously the way you'd price a thriving, fast-growing business at 40 times those earnings, and you'd get a Starlink worth around $176 billion. The whole company is being handed to you at $1. 75 trillion. The whole company is being handed to you at $1.75 trillion. The other 90% is a bet on things that haven't happened yet. So if the price is that detached from the business, why does it keep climbing the moment it opens? To understand that, you have to understand the order people stand in. Because this isn't one crowd buying at one price, it's a relay race. And you are not the first runner. You're the last. Picture the official offering price as the starting line. The runners who get to start there are the big institutions and insiders the banks hand shares to before trading even opens. They lock in their position quietly, days ahead. That's the front of the line. Now, demand for a deal this famous massively outstrips the shares available, so almost everyone who wants in at the offering price won't get it. When the stock opens and they still want it, they do the only thing they can. They buy on the open market at the popped-up price. And who's waiting on the other side of that trade ready to sell? Very often the exact people who got the cheap seats at the starting line. That's the relay. The baton being passed is risk. It travels from the people who bought low to the people who showed up late and bought high. The pop everyone cheers on day one isn't proof the stock is great. Mechanically, it's just the sound of the baton changing hands. And the person holding it at the finish is the one standing in their living room, tapping by, fully convinced they got in early. They didn't. They got in last. And it gets quieter and more dangerous from there because there's a wave most people never see coming. When insiders go public, they usually can't sell right away. They're locked up for a stretch, often around 6 months. The reason is simple. If everyone holding cheap shares could dump them on day one, the price would collapse instantly. So the lockup holds that supply back like a dam. But the water doesn't disappear, it waits. And when the lockup lifts, that held back supply can come pouring in all at once, usually right as the early excitement has faded and there are fewer eager buyers left to absorb it. Fresh supply meeting tired demand is exactly the combination that pushes a price down. And every one of those release dates is printed in public documents, months ahead for anyone willing to read them. Most buyers never open the file. This is where history stops being a story and starts being a pattern. When Uber's lockup expired, the stock hit an all-time low on the very day insiders were finally free to sell. When Rivian's expired and a major backer signaled it would sell, the stock dropped sharply in a single day. When Palantir's lifted, insiders sold into the enthusiasm retail had built, and the stock fell double digits in one session. Even companies that used a gentler, staggered release weren't spared. The pattern across all of them is clean. The higher the speculative premium at the start, the more it tends to hurt when the supply finally arrives. And SpaceX is debuting at one of the steepest premiums in years. Now let's bring this to the only question that actually matters. Forget predicting the stock. Nobody, not me, not the analysts, not the loudest voice in your group chat, knows what it does next month. So instead of guessing the outcome, let's measure the bet. Let's ask the fair question. What would SpaceX actually have to achieve just to make buying at this price worth it? And let's set the bar as low as we honestly can. Forget getting rich. Let's just ask what it takes to match the boring, lazy alternative, buying a plain index fund and forgetting about it. Call that about 10% a year. Start at $0.75 trillion.
To grow 10% a year for a decade, SpaceX would need to be worth roughly $4.5 trillion 10 years from now.
Fine. What does the business have to look like to justify $4.5 trillion? Be generous. Assume that by then it's a mature, admired company trading at a healthy multiple of its sales, richer than most blue chips ever earn. Even with that generous assumption, the math demands the company be pulling in somewhere around $560 billion in revenue. Sit with that. Around $560 billion, up from roughly $18.7 billion today. That's about 30 times its current sales. To get there in 10 years, SpaceX would have to grow revenue something like 40% every single year for 10 straight years without one stumble. Almost no company at this scale in history has ever done that. And remember, that near-miracle result is what's required just to tie the index fund, just to break even against doing nothing at all. For you to actually come out ahead, reality has to beat even that. So here's the honest conclusion. It isn't that SpaceX will fail. It's that at today's price, you're not buying a great company at a fair price. You're paying upfront for a near miracle and collecting the boring index return only if that miracle fully shows up. So where does that leave you? If you're genuinely drawn to this company, because the price is steep is not the same as never touch it. There's a smarter path than the two loud options. The first loud option is to chase the hype, buy on day one at the popped price, at the very end of the relay, right before the supply waves arrive. We've now walked through, step by step, why that's the weakest seat in the house. The second loud option is to write the whole thing off forever on principle, which throws out a genuinely remarkable business just because the entry price was ugly on one particular day. The third path is quieter, and it costs you nothing but patience. You let time do the work the hype is trying to rush you past. A few months from now, SpaceX will have reported real results as a public company, actual numbers you can hold it to. The forced buying will have run its course. The first waves of insider selling will have washed through, and the price will have had a chance to settle at a level that reflects the business instead of the excitement. Here's the part worth carrying out of this video, whether you ever buy a single share or not. The best companies of the last few decades stayed great for years. You did not have to own them on day one to do extraordinarily well. The market rewards the patient far more reliably than it rewards the early. The thing being sold to you as a once-in-a-lifetime, act-now moment is almost always a stock that will still be sitting right there next quarter at a price set by reality instead of a countdown clock. And if you want a tool for exactly this kind of thinking, the question we just asked, what would this price have to deliver to be worth it, is the one our members, the wealth logicians, run on every stock they consider. Inside the vault, there's a calculator that does it for you. You plug in a company's price, its revenue, and your own goals, and it shows you the growth that price is quietly demanding, so you can see before you buy whether you're paying for a business or paying for a story. If that's the kind of edge you want in your corner, that's where it lives. But whether you ever touch the calculator or not, take the habit with you.
The number on the screen will be loud. The countdown will feel urgent.
And none of it changes the quiet math we just did together. Great company, extraordinary story, but a price that's already written a miracle into the script. So should you invest in SpaceX? Watch the open if you enjoy the show. Just don't mistake the noise for a reason. I'll see you in the next one.